How will a recession impact capital raising? On today's episode, we'll explain why we may be heading into a recession, and we'll also discuss some strategies that funds can implement right now to help with raising capital in an economic downturn. Next. New GDP data shows that the U.S. economy contracted at a 0.3% annual rate in Q1 2025. And with tariffs continuing to loom over the economy, a recession appears imminent. So how should fund managers and real estate syndicators prepare for the impending downturn? On today's episode, Andy and I will discuss the likelihood of a recession, plus some strategies that funds can use right now to raise capital if the economy does continue its downward trend. Welcome to Fund Playbook. This is a show that's all about how to launch and raise capital for your very own private fund or real estate syndication. We go live every Thursday at 3 p.m. Eastern Time. Hit that subscribe button to follow the show. I'm Jimmy Atkinson. I'm joined today by my co-host, Andy Hagans. Andy, are we heading into a recession?
Looks like it, but we won't know for sure for 88 more days, something like that.
At least 88 more days, Andy. But so we've got a few web pages that I want to share on the screen right now, and we can just kind of walk through these for a minute. First of all, this comes from CBS News from just the other day. I think it was yesterday, actually. The new GDP data showed that the U.S. economy officially went into reverse in the first quarter of this year, a 0.3% shrink rate in the annual rate, down from growth of 2.4% in the fourth quarter of 2024. So this is brand new, fresh data, Andy. So this is one quarter of negative GDP growth, I should say. We also have a couple more links that I wanted to share here, Andy, and then I'll turn to you. Some projections or some odds making by some economists and big banks around the country. Is a recession coming? Here's what JP Morgan, Goldman Sachs, and other banks and economists say. And it does seem like odds of a recession have ticked up quite a bit just in the last month or two. JP Morgan Chase says there's a 65% chance of a recession this year. Wall Street economist David Rosenberg thinks the odds may be as high as 85%. And then Torsten Slok, who's the chief economist at Apollo, says that a voluntary trade reset recession is an almost certain 90%. Ray Dalio, billionaire hedge fund manager, says that he's worried about something worse than a recession. Andy, what do you make of all these projections here? And we've got a couple more web pages I want to show in a moment, but want to pause there and get your reaction first.
Yeah, and again, we're speaking now on Thursday, May 1st. So this Q1 GDP data was just announced. So we had that one quarter of negative growth, and the historical definition of a recession is 2 consecutive quarters of negative GDP growth. So we'll have to wait another quarter really to find out for sure. Are we in a recession? Couple interesting things, Jimmy, that popped out. One, that news article that you just read, it almost what was the exact word? A voluntary recession?
Yeah, it was a voluntary trade reset recession. That's from Torsten Slok at Apollo. I actually have a report from Torsten that he just published last week, Andy. I want to walk through that for just a moment here. He also has some anecdotes from the prior month from some industry experts. Southwest Airlines CEO says, "I don't care if you call it a recession or not. In this industry, that's a recession." Chipotle's CEO saying saving money because of concerns around the economy was the overwhelming reason consumers were reducing the frequency of restaurant visits. And then the CFO at PepsiCo saying, relative to where we were 3 months ago, we probably aren't feeling as good about the consumer now. And Andy, just to show you what Torsten views as the voluntary trade reset recession, April 2 was Liberation Day when the tariffs were rolled out. There's lags in the economy, Andy. There's a 20 to 40 day transit time for container ships. So really early May to mid-May is when container ships to U.S. ports are going to come to a stop. We'll start seeing less activity at U.S. ports. 1 to 10 days is when truck and rail transit times to cities occur. So May to late May, just in the next few weeks, trucking demand is going to come to a halt. We'll start seeing empty shelves and companies respond to lower sales probably in the next 4 to 6 weeks, late May, early June. And then we'll start getting layoffs in trucking and the retail industry. And Torsten is projecting a recession sometime this summer, 2025, Andy. So turn it back over to you. Love to get your thoughts.
Well, first of all, I think just that voluntary, that word, that adjective is so interesting because, I've really been thinking a lot about the last major recession that we had, the great financial crisis of 2008, 2009. And Jimmy, that recession wasn't voluntary. I mean, in
No.
hindsight, certainly, it's quite easy to say, well, we brought it on ourselves, right? With some policy decisions, some decisions at financial institutions, some decisions by the federal government and various bureaucracies that we kind of brought that on ourselves. But I think there was a feeling in 2008, 2009 that there were some major things going on that were unpredictable and that were out of our control versus a trade reset, voluntary recession. It feels a lot more like, wait, are we bringing the country into a recession on purpose? So that's a little bit different than like things are spiraling out of control and there are financial institutions that are, in a meltdown mode. President Trump is using the bully pulpit to sort of make the case. And I don't know that he's actually said this will cause a recession, but he's making the case for, there might be a little bit of short-term pain, but that's because, this protectionism or this industrial policy, these tariffs are part of a longer-term plan that he believes makes sense for our long-term economic health. Now, whether or not you agree with the tariff policy, and I think there's a lot of nuanced opinions versus just I'm for all tariffs or I'm against all tariffs. Whether you're for or against them, I think it does, Jimmy. It gives me a different feeling than I had in 2008, 2009, with the feeling that this is out of our control. This feels more like maybe this is the only way we're really going to bring down interest rates, Jimmy, is by this self-inflicted recession. So, does that make any sense?
No, it does. It does make sense. And I think, maybe those in the Trump White House have their eye on a much longer term goal. And by the way, I think on the one hand, you kind of need to be more short sighted about this if you are the Trump administration, because they only have another 3.5 years in office. And I don't know if this change is going to be brought about just that quickly. In terms of the protectionist trade policies, we need to onshore a ton of industries to be able to produce more goods in this country. And that's not the type of thing that you can just switch on like a light switch. We need to train our workforce in manufacturing. We need to build the manufacturing plants. I mean, it's going to be a decade-long process, if longer. So I'm not quite sure what they're thinking here with this tariff policy. It does seem to be very disruptive to the markets. Time will tell if it ultimately they get some good for the country, but for now, certainly it looks like the stock market isn't responding well to it, and the GDP economy at large is not responding to it as well. Just to pile on a couple more articles before we turn our attention to the follow-up to all of this, which is what should funds who are raising capital do if we are in fact headed toward a recession. But just wanted to pile on a little bit more. JP Morgan's CEO Jamie Dimon last week warned that a recession might be the best case outcome of a Trump trade war here. Andy, you just sent me this article a few minutes before we went live. I don't know if you had any additional thoughts on this one here, but I thought that was an interesting way to phrase it, that a recession could be the best case scenario here.
Well, a couple of things. Well, one is, some of the statistics that or the percentage odds that JP Morgan is giving the recession. What was it, 60% or something like that?
60%. Yeah.
Yeah. Whereas the CEO saying privately, well, recession is the best case. I just wanted to note
that is
little
interesting
disconnect between that private comment and the public comment. But one other thought, though, this is a little bit outside the box, but I have been thinking, and I have heard this from a few family offices and very smart people over the past few years. just the idea that the capital markets need a reset and that the country needs at least a mild recession, a reset of the labor market, a reset of the capital markets for its long-term health. And so I could almost read his comments as saying, a mild recession might actually be a good outcome. It'll make some things harder for fund managers, for instance, and for investors, but it'll make some things easier. So, I think what people kind of lose is that there is actually a bright side to a recession for fund managers, for investors, for entrepreneurs of all stripes. I know that's counterintuitive. Maybe it's a pretty unpopular message, Jimmy, but I genuinely think it's true.
Yeah, that's a good point, Andy. I mean, we move through economic cycles, business cycles, real estate cycles, and you do have to hit bottom sometimes, and you just don't want the bottom to be too deep and too prolonged. So I think what Jamie Dimon might be saying, if I can put words in his mouth, is I don't want a 5-year long deep depression, but if we could get by with a shorter term recession that lasts, maybe only a few quarters, maybe that would be the best case scenario. Andy, just two more things I want to show. I love showing Polymarket. Polymarket is a futures website where users can bet on the outcomes of particular events. And this particular futures market is asking if there will be a U.S. recession in 2025. And based on the pricing payouts of the different outcomes, either yes or no, about a 62% chance, according to this betting market, that will hit a recession before the end of this year. This spike up here from a couple days ago is because of that GDP data that hit. Got about as high as 66 cents or so in the last 24 hours. It's since leveled out to 62 cents. So about in line with what JP Morgan's official projection is. Now, Andy, our last big recession was in 2008 and 2009. And here's what happened the last time we had that recession. Private equity fundraising, according to this article from Venture Beat magazine at the time, it was written in 2010, hit a 5-year bottom in 2009, down 68%. Private equity, including venture capital, fell 68% to $95.8 billion across 331 funds in 2008, according to Dow Jones LP Source. So, Andy, this is a big deal. Obviously, the economy has a downturn and we officially enter a recession. It can be bad news for a wide variety of industries and individuals, and private equity, real estate fundraising, real estate syndicating are no exception. What's your reaction to this now 15-year-old article from VentureBeat that was written at the time of the last recession?
Well, I just think that there's such a paradox here because obviously if you're raising capital and you're in an industry where the amount of capital raised decreases by over 60%, by basically 2/3 from its recent peak, that is hugely stressful. It makes your life a lot harder. Probably a lot of people get laid off in that industry. But thinking about venture capital, because that article venture at VentureBeat references venture capital as a component of private equity. 3 years ago, talking with fund managers in the VC space, everyone was saying it is so obvious that valuations are out of control, and that even fund managers would say, we don't think this is going to be a good vintage for venture because too much money flowed into this asset class. And as a result, there's too much money chasing too few good deals. And the returns are just going to be compressed for this vintage. And you saw some funds just returning capital to GPs and saying, we're not even going to invest this. We're not, we are able to raise the money, but we didn't find any opportunities. Now contrasted with a couple of years later, with a much harder, fundraising environment already, even though, we're not necessarily in a recession yet, but it's already a harsher, harder capital raising environment. Already you've seen valuations correct somewhat in the venture space, which paradoxically maybe means that it's harder to fundraise, but that actually is better news for those current investors who are getting in at that time. And so I think that holds true in commercial real estate, in venture, leverage buyout, all types of alternative asset classes. There's just like this kind of paradox that the bad news is good news, and then if you flip it and you say, such and such asset class had a banner year, record amounts of capital raised for multifamily syndicators in 2021, that kind of makes you go, maybe that's not going to be such a good year, such a good cost basis to be investing in multifamily that year,
Yeah, quite possibly. By the way, that was the year in which I've invested heavily in multifamily. So fingers crossed there. But what are you going to do? Hey, so let's move on to our big follow-up question. By the way, for those of you here in the live stream right now, don't be shy. Feel free to pass us along any comments or any questions in the chat. We'll highlight some of our favorite ones, and we'll answer as many of your questions as we can throughout the course of the show. But Andy, the big follow-up question here that I want to address to you is, if we are headed into a recession, and it certainly looks like we are, and a lot of prominent economists and CEOs of major firms are suspecting that we are, what can fund managers and real estate syndicators who are trying to raise capital during this period do in order to best position themselves for a capital raise during a recession?
Well, I'll give you two tips, Jim. I mean, the first one is just recognize the reality, right? Psych yourself up, just understanding, okay, raising $1 million, raising 10 million, raising 100 million, it's all going to be a heavier lift than it would have been in 2021, right? That's just the reality. Even though what I said, I believe it's usually a better time and a better cost basis to invest in alternatives during these periods of market turmoil or fear. That's not necessarily part of your normal LP investor psychology, right? Because that fear of the markets overall, that feeling of a recession and the sort of bearishness across the economy writ large, that's going to affect investor psyche of the vast majority of LPs that you're pitching. But I would say, across all of these alternative asset classes, usually the number one reason that an LP will cite that they want to invest in alternatives is that, they don't want to be subject to the ups and downs and the wild gyrations of the market, that downside protection, the lower volatility. So I do think that is definitely a place to start, right? Depending on your deal or depending on your asset class or your fund. If you have any part of your pitch that is, hey, our fund is going to have less volatility. It may be illiquid, but historically, for instance, real estate may be less volatile than the stock market. That would be just the place to start, to sort of recognize where the investor is psychologically and start with, okay, let's start with that.
Yeah, I think that's exactly right, Andy. I think that is a good point to, first of all, come to grips with the fact that things may slow down. I was actually on a call last week, Andy, with an emerging fund manager. He was considering acquiring some real estate assets and offering a fund. And he asked me, he said, hey, Jimmy, how long does it typically take to close a fundraise? And I said, well, first of all, it depends, right? Yeah. It depends on a lot of factors. And I kind of went into some of those factors: size of the fund, what's your existing investor base look like. But then I also cautioned him. I said, by the way, it could take months, if not a year or 2 years, possibly even longer. And don't discount the fact that it looks like our economy is entering into a downturn right now. And if we enter into a recession, what you're going to see is a lot of investor behavioral shifts. And what do I mean by that? We're going to see a flight to safety. Investors are going to pull back from riskier, especially illiquid types of investments. Not all of them, right? I shouldn't say that illiquid investments are going to completely shut down, but there's going to be a huge pullback. Like there was in 2008 and 09, we saw that article from VentureBeat cite a 68% reduction in capital raising during that period. I think that's a very real possibility. And the writing's on the wall that could quite possibly happen. Again, investors just flee to safety. They see their 401ks, their retirement funds go down sometimes by as much as 10, 20, even 40% or more. That scares people, right? The last thing they want to do if they see their 401k experience a 40% drawdown is put money into an illiquid real estate investment. So just come to grips with that fact. They're just much more risk averse during times of economic downturn than they would be otherwise. Andy, do you see it any differently? Do you see it any other way?
No, I think you're 100% right. But I would say, and I think that this is true. So this isn't just like a marketing or a sales pitch. I think it's incumbent on the fund manager to reframe how they're marketing their deal is. So let's take, for instance, commercial real estate. So when I was talking with family offices, ultra high net worth investors in 2023, I remember we were at a family office conference, and there was just so much cash on the sidelines, and it was like, hey, we had a market run up, we are sitting on cash, and indeed since that time, family offices and a lot of investors are sitting on even more cash. But the idea being, we don't want to deploy this in commercial real estate or alternatives until there's a correction in valuations, because we want to get in at a lower cost basis, right? Because at that time, even in 2023, where the market had corrected a little bit, there was a feeling, cap rates need to expand a little bit more, valuations need to be a little bit more attractive before we're going to start buying into some of these deals. Well, assuming that there's a more widespread recession, not just the sort of headwinds that we've seen in CRE in the past 2 years, but an actual recession with actual, more clear-cut cap rate expansion and just more distress across the marketplace, Jimmy, that is the exact time to me to say, hey, look, guys, this is what we live for. Every 10, 15, 20 years, that year-long period or 2-year period where there's a lot of distress, where you can pick up quality assets for maybe not pennies on the dollar, but dimes on the dollar or quarters on the dollar or whatever. Everything is on sale. This is the time to move. And I think it's true, right? And so if you as a GP believe it, I think you're going to find there are other LPs, there are family offices that believe it too. And you kind of, if an LP doesn't at least have a little bit of that contrarian take and willingness to be bold and willingness to wade in and buy assets at a discount, then they're probably not the type of LP that is going to invest over the next 12 or 24 months. They're probably the kind of LP that's going to wait for a huge market run up until cap rates have compressed to their historical lows, and then they're going to invest at the very top of the market. So it is what it is.
Yeah, I do think investors tend to move in herds, Andy. I think most investors are greedy when others are greedy, and they're fearful when others are fearful. But the savviest investors work the other way oftentimes. They're contrarian, like you pointed out. They are fearful when others are greedy, and they're greedy when others are fearful. So when there's blood in the street, that is oftentimes the best time to start buying up assets. So I would say, this is my advice to anybody who's thinking about a new fund or real estate syndication strategy. They're looking to launch a fund. I think the investment thesis heading into a recession, or especially once we're in a recession, needs to be one that is trying to attract family offices and other cash-rich LPs who have a lot of dry powder. Those folks who haven't purchased any assets during the run-up, or they've purchased selectively during the run-up and now they're waiting for this opportunity for asset prices to crash. You need to position your fund as a distressed asset fund, and you're going to go out and buy undervalued assets once that crash happens, once we're in that economic downturn. Because out of recessions can oftentimes mint tons of wealthy investors who waited for the right time. And I don't know when the right time is. Timing the market can be a fool's errand, but you can sometimes see when there's major cap rate expansion, when asset values drop like they are, Andy. And if you can have a longer term view, well, what is this asset actually going to look like maybe in the next 5 or 10 years after we pull out of this? I think that can help attract, that type of strategy can help attract those folks who have kept some dry powder on the sidelines all this time.
Yeah, and Jimmy, one other, let's say, encouragement that I give to emerging managers or seasoned managers is don't be afraid to think a little bit smaller, but remembering that every dollar, if indeed we go into a recession, if indeed we see widespread distress in commercial real estate, every dollar raised and deployed into a deal during a time like that is likely to be a lot more valuable, both in terms of future IRR and future returns, but also in terms of your track record and your brand story as a fund manager, right? Because those deals, again, when you invest at that lower cost basis in times of economic distress, widespread assets on sale, they're typically going to deliver higher future returns. So if you're an emerging fund manager still sort of building that track record and building that story, it can be a hard time to get started. But one of those things in hindsight, 5 or 10 years later, you might say, well, I survived and then later thrived. And in a weird way, it was the perfect time to get started. And, I think one other thing I would make, more tactical advice, Jim, is this might be the wrong time to go do a deal that it's the biggest deal that you've ever done, and it's kind of all or nothing. Like, I need to go out and raise 100 million, 90 to 100 million, or this deal isn't going to work. Instead, you might be looking for a series of smaller deals or a type of a fund, Jimmy, where you're like, I need to raise at least 20 million or whatever the number is to make this fund economically viable, and I'm going to raise up to 100 million or whatever the number is, but I have a wider range of fundraising outcomes where I can still operate in and be comfortable in, versus we're making this big, bold bet on this one project and we need to raise X amount of dollars or the whole thing doesn't work.
I think that's great tactical advice, Andy. I'll give a few more strategical pointers of types of marketing you can use if you're looking to raise capital during a downturn. First of all, I would say if you do have a track record, if you do have experience, if you invested through the last recession, start there and lean into that heavily. Say, hey, my group or I as a GP have invested through the last downturn. We were in deals in 2005 through 2010. We bought a lot in 08 and 09 when there was blood in the street. I think that's a great story to lead with. Show what you did coming out of the last economic downturn. Now, if you weren't there, if you're newer and you don't have that experience, Andy's exactly right. Use this time as that experience for, down the road of a future raise, and start smaller. But some other things you can do, I think, in some of your marketing or in some of your discussions with investors, emphasize the downside protection. Emphasize the downside protection of getting into a non-correlated asset like real estate, particularly in recession-resilient asset or recession-resilient sectors. I would say housing. Everybody needs a roof over their head. Some type of industrial, possibly. I don't know how well retail may do during a recession. That might be a little bit dodgy. Andy, maybe you can counter me there, because I know you're the new strip mall guy, basically, but a modern day strip mall guy, I call you sometimes. But I really like housing, and self-storage can often do quite well during recession. Also, as people are downsizing their homes, they can still have all the stuff. They got to find a place for it. Healthcare, government services, those types of assets can do well during a recession. And then I going on the other end, from being a defensive strategy, try an offensive strategy. Try rebranding a strategy around opportunity. So you're going to perform distressed acquisitions. Your investments are counter-cyclical. You're taking advantage of opportunity or market dislocation. You're going on the offense. That could be another, or contrarian is a word we used earlier too. That could be a strategy that's a little bit different from that defensive strategy that you can try as well. And then absolutely just need to be patient with investors and with the capital raise, because I think it will take longer raising in 25 and 26 if the recession comes to pass like we're expecting it to. And it's going to be a little bit of a grind, but you can still get it done. A lot of capital was still raised even in 08 and 09. Not as much as there was in years prior, but there was still investments being made. But Andy, I I bashed your favorite asset class. What do you think is going to happen with retail in the coming years? Retail real estate investor, I should say. Excuse me. If a recession comes to pass.
I don't know that it'll be that much different than, for instance, multifamily or industrial, which is to say it depends, right?
Yeah.
Like already in multifamily, we're seeing different subsectors, different geographic areas get hit pretty hard. And then others, like, for instance, in the Midwest, multifamily is doing just fine, in general, compared to some other markets where it's facing more headwinds. So, just one other point, you referenced 2008, 2009, and I think this will hold true for the next recession, whenever it is. Just remember, if there's fewer LPs to go around, if there's fewer LP dollars to go around, and if it's taking longer to close that capital, a recession is also a good thing in terms of it's going to bleed out some of the competition, right? Like, think about how many multifamily syndicators there were in 2021, early 2022. It was like they were coming out of the woodwork. People have never syndicated a deal before. I think a lot of those guys are already gone, right? Let alone going in, if we actually go into a recession, there's just going to be fewer people starting funds, fewer people syndicating deals. There's going to be real estate agents, real estate brokers, loan agents, all kinds of participants in the industry leave the industry, go find other things to do, go find other companies to launch, et cetera, and so forth.
You got
And
it,
so
Andy.
again,
Well,
yeah.
let's go to the phones and see if anybody has any questions. And by the way, if you are in here, you're a part of our live audience. Don't be shy. If you have any questions or comments for us, we'd love to read them on air and address them. So please feel free to submit your questions or comments in the chat, and we'll get to as many of those as we can. But Andy, I got this question via email a week or two ago from Scott. Scott asked, what are the biggest risks involved when starting a private equity fund or real estate syndication? What do I have to be wary of as a GP?
Well, three things, just off the top of my head. One would be your personal reputation or relationships if the deal goes south, depending if you raise money from family and friends. Second would be your net worth, if you have to sign on to a personal guarantee, which a lot of GPs do, especially early on in their careers. And then third, if things go really south, or you really, are flouting the rules with securities law, you might go to prison. So there's a lot.
You're making it sound so great.
There's quite a lot that can go wrong, I think, when you're starting a fund or syndication. Isn't that the truth?
I think it is true. I think that's part of one of the biggest things you can do to de-risk your involvement in a private equity fund or a real estate syndication is to surround yourself with the right team. And we talk about this on one of our first, I think it was episode 2 of this podcast, Andy. We talked about putting together a team around putting together a fund, and particularly having a good CPA and a good attorney to help you get everything structured properly. And so you're legally compliant with SEC regulations, so you can go out to the market and start raising capital. I would say another big risk, Andy, is the chance that you start fundraising and you aren't able to close it. You aren't able to raise enough. And so what happens in that case? Well, your investors are out a lot of money. You probably have to return some capital. You're probably returning maybe 90 cents on the dollar because you've had to spend some of that money on marketing and legal expenses. Maybe 90 cents is even optimistic. You're probably going to return that capital to your investors at a loss for them, and people are mad at you, risking your reputation. So I would say before you even go out to market, nothing's 100% certainty. You can never be 100% sure that you're going to be able to close that fundraise. But I would at least say before you actually start raising capital, do a friends and family raise, do a raise among existing investors in your network, or at least getting some sort of indication of interest from people. Send around an email, host a webinar, get people to sign some sort of, or raise their hands in some way, maybe even just email you some sort of indication of interest as to how much money they would put into your fund before you officially launch it. Because once you get all the paperwork filed and you put it out there and you bring in money from one or two investors, then you're kind of stuck as you're on a one-way street for the most part. That would, I would say, be one of the biggest risks. Andy, did you have anything else to add there?
I think you're absolutely right. De-risk it.
Yeah.
I think people get this idea that you have to launch everything with like a big splash. And I would argue that a lot of successful careers do things the opposite, right? Even people that are still working the 9 to 5 day job and doing their first syndication on the side with just one or two investors and relatively small amounts of money, to kind of get going that way. So I 100% think de-risk it as much as possible, because as we said, it's scary enough. There's a lot that can go wrong as it is. So if it's something you want to do, find a way to do it intelligently where you're not risking everything and, betting the farm on it, so to speak.
Yeah, good thoughts there, Andy. Thank you for that. Let's move on to our next question. This one I got over the phone from multiple people over the past 2 months, I would say. I oftentimes advise developers who are considering rolling out some sort of private equity real estate fund, maybe even a qualified opportunity fund within the OZ industry. And oftentimes I get asked this question. So Andy, I want to pose it to you. What is a typical return that investors expect from a private equity real estate fund or a real estate syndication?
That's a great question. And I mean, well, Jim, I'll just tell you what I think, which is, an alternative investments. Although, we talked about earlier in this episode about the lower volatility that they have compared to the stock market, there still is that perceived risk of it's an illiquid investment, which it is, and that there should be some risk premia attached to that. So to me, unless it's a very specific kind of alternative investment, like hard asset backed private credit or something like that, I'm going to want to see double digit returns.
Yeah, for sure. Double digit returns. I always answer this question by, well, it depends. It depends. I would definitely say for any type of illiquid investment, you want to at least, at the very least, you want to beat the risk-free rate, right? And then, right now you can get, what kind of interest rate can you get on a high yield savings account or treasury? Somewhere in the 4 to 5% range. So for sure you want to beat that. But then I would also say you actually want to beat the stock market too. You want to beat the broader S&P 500 or just a total stock market type of product. So now you're talking about somewhere in the 6 to 8% range is what that has historically paid out. Otherwise, why would I invest in an illiquid asset that has a fairly high degree of risk? But then within real estate, Andy, I would say it depends what type of asset you're getting into, what type of real estate investment it is. If it's a core or a core plus asset, maybe your investors are really looking for cash yield annually. They're not really looking for a huge amount of growth, maybe somewhere in the 8 to 10 to 12% annualized return range. And they want maybe like 3, 4, 5, 6% cash on cash yield, somewhere in that range, I would say. On the other end of the spectrum, though, and a lot of the funds that I advise are opportunity zone deals that are doing ground up development, all the way on the other end of the spectrum, you really need IRRs in the teens at least, if not in the into the low 20s, I would say, is the IRR you should shoot for. You're not really promising cash flow to your investors for the first 2 or 3 or even 4 years with a ground up development deal. But you do want a fairly substantial equity multiple, either somewhere in the 2 to 3x range, I would say. And any pushback there, or am I in the right ballpark, do you think?
No, not at all. But when you reference, core deals in that 8 to 12% return range, I'm like, oh, that could have been pretty challenging to achieve if you were buying in 2 or 3 years ago.
Definitely.
So that's where back to my first point, a period where we see a little bit of distress in the market. I think that's where you can kind of have your cake and eat it too, provided you have liquidity and some cash to invest. You can get quality assets, but you can also buy them at an attractive price.
Right on. Andy, we did get one comment here, and then I think I'll cut you loose. I wanted to read this one. Thanks to Core Tax Deeds for watching the show today. He says, "Hello, Andy and Jimmy. Love to catch up with you and share our recent success with Core Tax Deeds. 5 exits as of yesterday on Texas tax deeds. What effect do you see knowing that tax assessed values doubled in the past 5 years?" And boy, yeah, I'm in Texas, Andy, and my tax assessed values on my home here have gone way up over the past few years, and the property taxes here are no joke in Texas. So I don't know if you have any additional thoughts as to what
Well,
effect
Jimmy,
you might see.
well, just what a little humor. At least your insurance premium has gone way down, right? To kind of
That's
compensate.
funny.
No, in all serious, the tax deeds, that's an area outside of my expertise. But I mean, this sounds like an interesting topic. Shoot us an email, Jimmy. What's our official producer email or show email where they could send us some more information on their deals, because this would be something interesting to just kind of look into.
Yeah, absolutely. Shoot us an email. Our email address is info@fundplaybook.com, because we'd love to hear more about that. I've talked with a couple other investors in the past that have been interested in tax liens and purchasing tax liens at auction. I think it's a really interesting asset class, a really interesting opportunity, but I don't know much about it either. So core tax deeds, email us. We'd love to hear a little bit more about that. Info@fundplaybook.com. And thanks for watching the show today. Andy, I think we're out of time. Great stuff today. Thanks for joining me today. Now, our next episode and live stream will be on YouTube next Thursday at 3 p.m. Eastern Time. You're invited to attend the live stream on YouTube and ask your questions about starting a fund or real estate syndication so that Andy and I can answer your questions in real time. Please be sure to subscribe to us on YouTube. And if you enjoyed today's show, hit that thumbs up button. It helps us out a lot. It helps us get the word out about the show. By the way, Fund Playbook is now also available on Apple Podcasts and Spotify. Just search for Fund Playbook on the app or visit fundplaybook.com and click the Apple or Spotify button. Thanks for watching and listening, and we'll be back next week with another episode.